What if the next evolution in investing didn't come from Wall Street, but from a blockchain protocol? One that's designed with regulation in mind from day one. And what if that same technology could offer a new level of precision for how we buy and hold equities, splitting dividend income from capital growth in a way that traditional markets never could? Well, today I'm joined by Gene Hoffman, CEO of Chia Network, a blockchain platform that's taking a fundamentally different approach to Web3 infrastructure, one that's grounded in compliance, sustainability, and real-world utility. Because Chia's latest initiative is a joint venture called Permuto, and they're aiming to revolutionize equity markets by launching a tokenized securities on-chain. And not just any securities. I'm talking about Microsoft stock, which is going to be their first to be broken into separate dividend and appreciation certificates, ultimately giving investors more granular control over exposure to market volatility. And this isn't just a crypto project with lofty goals. Chia is actively collaborating with regulators and preparing for its own IPO. And Gene himself will be participating in the SEC's upcoming roundtable on tokenization, helping to shape the future of how traditional and decentralized finance converge. What happens when you bring together compliance-first crypto, scalable blockchain infrastructure, and one of the most recognizable equities in the world? Well, let's find out by getting today's guest on. So a massive warm welcome to the show. Can you tell everyone listening a little about who you are and what you do?
So my name is Gene Hoffman. I'm the CEO of Chia Network, Inc. Chia Network is the software company behind the Chia blockchain that was invented by Bram Cohen. My background, I'm a serial technology entrepreneur, helped invent internet ad blocking and cookie cutting, went to PGP and helped into export controls there, almost started a cryptocurrency in 1997, instead built this little company called emusic.com that helped launch the iTunes music store later and the iPod originally with Tony and crew. And then for the last few years before that, I was doing all the back-end infrastructure for over-the-top television. So your credit card was probably part of my previous company's database, and sold that to Amdocs in 2016. And knew cryptocurrency was what I needed to go do again. And when I heard Bram had a solution to the proof-of-work energy problem, I said, dude, we got to talk.
Oh, man, what a great story. And you mentioned Bram Cohen there. I last spoke to him, I think it was around 6 years ago. It's crazy how quickly the time goes. And for me on the outside looking in, it's just fantastic to see how much the project has evolved since then. But for anyone listening that's new to the story, can you just give a brief overview of the vision and that Bram shared with me a few years ago and where it stands today?
Yeah, so there were kind of three big things that we wanted to fix. Thing number one was proof of work is a kind of genius and horribly ingenious idea. It's almost perfect, but it has this flaw that it, as you scale it up, just keeps going linearly in power. And that's not necessarily what you want if you want a 10x or 100x, a blockchain's utilization. And then on top of that, Ethereum had shown people what the demand for, frankly, really bad smart contracts was. And so, if you went from first principles, what would you build to build the ideas of smart contracting, but to make them secure from North Koreans and other sort of, nation state attackers? And then finally, blockchains had always talked about wanting to get real world adoption. And so Bram and I were very focused on, what are these use cases that require blockchains, and which are the use cases that blockchains will just make materially better for everybody in the world? In fact, we kind of long-term don't think most people will know they're using a blockchain. It's more that products and services will be cheaper and faster and, more accessible. And just, the blockchain is making it happen in the background and cutting out trusting so many middlemen.
And I think one of the most attention-grabbing developments is the launch of Permuto. I think hopefully I've said that right. So what exactly is that, and how does it aim to change how we invest in everything from equities, for example, and starting with something as big as Microsoft stock? Sounds incredibly intriguing. Tell me more about that.
Yeah, so a little background. We did something else a little different at Chia. We decided to put the coins in our company, not sell them to investors, and we take the company public. And in that process, we'd hired Credit Suisse First Boston, which of course means that I have a funny later story about how Credit Suisse First Boston dies after we file our IPO.
Oh,
But it means that a whole bunch of really interesting investment bankers are all over Wall Street and know the kind of inside Chia story. And one of them had been troubled by how we value blue chip stocks since he was in college. And he's like, I think we can strip just the dividend out from the rest of the equity and trade that independently on the Chia blockchain, because he had seen, how receptive the SEC was to Chia and our technology and how it was truly peer-to-peer and could allow you to actually use what are kind of really old SEC regulations about like trading paper stocks. Instead, it's substituting a crypto paper stock for them, if you will. So what Permuto does is it takes ultimately about 85 of the largest companies in the world and separates their dividend from the rest of the equity. And so for Microsoft, that was our first one. It's kind of a real leader here. It was one of the early tech companies to add a dividend. This entire concept that tech growth companies would have dividends is really new. It used to be that like your, electric company or your oil company got big and then started paying dividends. It wasn't growing too much, but it's throwing off a bunch of money. Well, Microsoft was both growing and throwing off a bunch of money. And so even though Microsoft, and I probably get the exact numbers wrong, but it's kind of 4x'd its dividend, while it's gone down about 5x as compared to the yield because the stock has gone up so much. And so almost no one buys Microsoft for its dividend. But it turns out that the dividend separated from Microsoft stock is probably worth about $50 a share. And it would yield something between 5.5% and 7.5%, which is kind of better than American Treasury bills. So, all of a sudden there's this investor class who never would have bought Microsoft stock, who absolutely could buy, we call them dividend certificates and asset certificates. The dividend certificate is just the dividend, the asset certificate, everything else. And so we've come up with a regulatory path and we filed this with the SEC. It's like an IPO. It's also a little bit like a direct listing, but basically what happens is we're going to build a book of people who want these two different sides. We're going to go out and pull Microsoft shares in, put them at our custodian U.S. bank, and then hand out to each person who's deposited their shares one dividend certificate and one asset certificate. And so just to bring it very personal, like say you're a young investor, you're like 25 and you believe in Microsoft and Apple and Broadcom, and those are our first three that we were publicly talking about. You probably should do this and sell the dividend, because the dividend is not very tax efficient. You're going to pay taxes every year. And, you're young. You're looking for the overall growth of these companies for the long term. So what you do is you sell the dividend, you take that dividend proceeds, you buy more of the asset certificate. And the way the asset certificate works, it's the dividend minus the underlying stock. So already it'll go up in the Microsoft case about 15% more per dollar. And by the way, down 15% more dollar too, compared to the underlying. And if you do this, you're talking about adding like 5 more points to it because you bought even more of the asset certificate with what otherwise would have been your dividends. And, as you age, you might start buying back and setting the dividend wherever you want to. Like it's a 0.7% today. You might want it to be at 3. And so you buy enough dividend certificate to make it be 3. And as you retire, you sell off your asset certificate and you now buy a bunch of dividend certificates, and that's your cash flow into retirement. So it really kind of takes the old, what you should be doing over your lifetime and makes it even more precise and easy to execute. And what's of course very cool about this is it trades both on the New York Stock Exchange and on the Chia blockchain. And in fact, it's much cheaper on the Chia blockchain because it turns out that it's dramatically less expensive to administer all of this using a blockchain. So it's one of these things where long term, this product wouldn't make sense overall on just traditional rails, because just a great example of this, we pass through the tax positive treatment of the dividends. And it means we have to give you a K-1 in the United States. This is a thing you use to report your taxes. In the traditional world, we have to go spend something like $400,000 per trust to go find everybody and their social security numbers and bring that all back together. On the blockchain, one time we write an application which lets you log in with your wallet or your vault and immediately generates your K-1 from all the activity we observed on chain from your assets. So, right there, we're saving $400,000 per. So you can see where, this originally needed to be a blockchain project. It turned out that we had an opportunity to make it both and give people real training wheels. It's like, look, if you're afraid of the chain today, start over here. You'll pay twice as much of the dividend, but you'll still be getting a dividend you never could have gotten before. And as you get comfortable with it, you can move over for free. So literally you can go, it takes 24 to 48 hours, but then it'll end up that the stock that was over in your E-Trade account is actually now in your Chia wallet.
It's incredibly cool what you're doing here. And I'm curious, this splitting of traditional stocks into dividend and appreciation certificates, how has that been received by, I don't know, traditional retirees and institutional investors? What kind of feedback have you had here?
I think people are really excited about it. And the more you dig into it, the richer it gets. So like a good example is like if you had bought PepsiCo, a big food and beverage company here in the United States 5 years ago and just held the stock, you would have made about 6%. But if instead you looked at it and went, I don't know if PepsiCo is going to get a high price to earnings ratio, the market's going to be weird, I'm going to buy just the dividend certificate and hold that for 5 years, you would have made about 92%.
Whoa.
And if you wanted to go a little crazier and thought, no, I really think this thesis about the stock price not going up much is bad, I'm going to short the asset certificate, you would have made 109%. So it's this ability to kind of decompose companies into their fundamental performance and their stock price, because those aren't always exactly the same. You have times where certain companies fall out of favor, even though like GDP is growing well and the demand for Pepsi and Taco Bell remains pretty darn high. And during the period, they're throwing off more cash, so they move their dividend up. It's those kinds of scenarios where this makes a ton of sense. So it really is kind of what we think the next major step in investing is since the ETF.
And 6 years ago when I last spoke to your founder there, everyone was talking about crypto being too volatile. And of course, now here we are in 2025. Recent AI-driven market volatility has raised new concerns about how investors manage risk. If we take something like Nvidia, it can be all-time high or all-time lows within 24 hours. So how do you see your approach helping stabilize portfolios or provide a more flexibility to different types and classes of investors?
Well, it's interesting because what we're going to do is create three legs of a stool. And what I mean by that is for the tech companies where the dividend is a very small component of their overall value, the dividend certificate is going to be extremely stable. You're basically only going to be looking at what their dividend policy is. And, Microsoft, Apple, Broadcom, basically since inception, only in really bad years did they not raise their dividend. So like in 2008, none of them raised it, but they didn't lower it. And in fact, if anything, you've seen them raise it even faster as they've grown. Now, if you want the regular volatility, you may want to own Apple stock directly instead of either the asset or the dividend certificate. But we are very comfortable in the Apple case that your dividend certificate is going to be a lot less volatile because, again, you're betting on the next, 5 to 10 year cash flows of that dividend. And right now it doesn't look like the iPhone's going anywhere fast. This is not Walgreens or Rite Aid here in the United States, right? And, because companies that cut their dividend, everybody knows it's coming. It's not usually a surprise, right?
Yeah.
So you get this opportunity to say, hey, but also maybe I want more volatility. Again, I'm a young investor. I think about this over the long term. I'd rather own a Broadcom because I believe in AI. And I believe that they're, the second biggest beneficiary of the AI boom. And you know what? I want more volatility because I want to ride up and beat the S&P 500, effectively by having an asset certificate that's got this extra leverage in it.
And before you joined me on the podcast, I was also reading that you've compared this to the new evolution of ETFs. Can you expand on that idea and explain what this could mean for the broader financial ecosystem if we zoom out for a moment?
Yeah. So, before the ETF, if you were a professional, even individual investor, you kind of had to buy a bunch of what you knew. Like, you can only look at so many companies, you can only come up with so many theses. And, the classic, hey, the brands you bought at home and appreciated were often the ones you should buy. And look, that has worked even later. Like without meaning to, I kind of follow Berkshire Hathaway on Apple personally, just because back in 2008, I was like, well, if the world's ending, everybody still wants an iPhone. And that was a pretty simple thesis to actually make a lot of money on if you look back. But then ETFs came around and said, hey, look, you're paying a lot of money for other people to do this work for you. Why don't you just, pay a very small fee and get much broader, access to the market? Why not buy the entire S&P 500? And in fact, what ended up happening is at first professional investors were like poo-pooing this, right? How dare you take this away? Now professional investors are like, well, this thesis requires me to go short the entire market. And I can do that in 5 minutes with the entire market, short ETF. So that's where we've kind of gotten to. And the next iteration is to say, okay, now, what if you could, like in the Pepsi example, really dig in and look at it and go, wait, I actually believe in the cash flows, but don't believe in the stock. That's a new thing to think. And then that goes to the next level where I think the highest yielding dividend ETF yields about 2.7%. Well, real quickly, they're going to want to move to using the dividend certificates and yield more like 6-7%. So, it's going to force almost all the dividend ETFs to move into this product because it makes them now perform much closer to the actual dividend without all of that kind of drag from owning the capital asset. So, we think that's going to be very interesting. We also think there's going to be a real opportunity for people to kind of build a synthetic S&P 500 index fund that actually uses these asset certificates. And so we'll go up faster than the S&P 500 in good years and down faster in bad years. So, I think these are all things that are now going to force anybody with an investment thesis that has any of these large cap dividend payers in them to think about how they build their product, build their portfolio.
And Chia's always stood out for me for its regulatory first mindset. And I know that you're also participating in SEC's crypto task force roundtable. So what's the latest on Chia's regulatory journey and potential IPO plans? Anything you can share around there?
Yeah, certainly. Well, first, there's one key thing. So I hold the world record of being the youngest CEO of a national market public company in the United States ever. And so when Bram and I were in 2017 looking around and watching people do illegal unregistered securities offerings, we were like, we're not doing that. Yeah. And, that knowledge of capital markets and how the true capital raising process works legally meant we also kind of made certain design decisions as we developed the Chia blockchain to make it so that it would fit very well with traditional regulations. And I mean traditional regulations, I mean like pre-1975. It's how did the stock markets work before we kind of electronified them, even though we didn't do a great job of electronifying them, if you will. And so, we really saw an opportunity where we think that like equities trading and ultimately things like commodities and bonds, like bonds are a great example. You currently pay like quarterly or semi-annually. And so like the bond kind of goes up and down depending on how far away it is from the payment date. Well, the thing about a well-built blockchain is all of a sudden you could pay your coupon weekly, maybe even daily. And this is just a thing you couldn't do in the past. Like it was just way too expensive, way too painful. But the blockchain finally makes that manageable and tractable. And it really kind of opens up what I would call Wall Street creativity. We've kind of, since ETFs, not much creative has happened on Wall Street. I mean, I guess, the mortgage-backed security, which was creative, all right, but not necessarily what we all wished the creative to be. So, when Bram and I were looking at building this, we'd always taken how does this work to truly reduce the regulatory footprint of this stuff? I mean, when you do a trade on Chia, it's truly peer-to-peer. The only other person is the person who meets the, cryptographic standards that you require to trade your Microsoft dividend certificate for USDC. And so all of a sudden it means that there's a much more light regulatory touch needed because the only thing you're trusting is the blockchain secure. And that's something that we know how to do, right? It's the both academically proven sets of information. You audit against that academically proven infrastructure to make sure your code is doing what the actual underlying math is supposed to do. And you can have a whole different world where instead of like trusting an institution, you're just trusting that a blockchain is going to do what it says it's going to do. It's a very powerful change to how we've kind of done 400 years of economy.
And if we look ahead, are there any other use cases or sectors that particularly excite you, make you want to jump out ahead in the morning, especially when you're looking at Chia's blockchain infrastructure powering in the near future? What excites you there?
So we have this concept we call one market. And what it boils down to is, when you think about things today, there's this weird separation of like real estate from stocks. Like the way you get from real estate to stocks is you go to cash. Yeah. Well, why couldn't you just buy a house with stock? Now, the answer is today it's a pain in the derriere, but with a well-built blockchain, the answer is it can be trivial. And in fact, it can be even more trivial in that there's kind of these liquidity pools where it's like, well, if the house seller doesn't really want your Apple stock, you can structure the transaction so that the seller's actually getting like USDC because the trade is actually going to cash in the same transaction that then pays out the house seller. So we're real interested in, especially earlier, these things that should have titles but don't. So think about like a Rolex watch or a high-end bicycle. Like automobiles, houses, titles are pretty good. We kind of understand how to track those. But, if you could have an eBay where you can buy high value goods and you got title to it in a way where you no longer have to go to the McDonald's parking lot and like take the risk that somebody's going to take the cash from you, This is really powerful capability. And so as we go from kind of classic financial instruments to these kind of in-betweens, and then later the actuals, again, there's no reason like the DMV shouldn't be starting your car title on chain and then having an actual immutable record of what happened pre-sales, after sales, the idea of like lemon cars going to new state just kind of goes away, right? So we're excited about this one market concept of bringing everything online to be tradable in a very trust minimized way. And there's this other piece of it, which is we're also kind of excited about. We've built much better custody. So self-custody is actually like human approachable and recoverable. And if you die, there's a path and it's still very secure. Well, that also is a really great way to log into your email, actually. And so longer term, we're interested in taking what we're kind of building where, financial institutions and investors are holding Microsoft stock in a Chia wallet secured by their iPhone and they use that same infrastructure to log in at even a like Department of Defense job because it's actually the best single sign-on from a security perspective on the planet. So it's really kind of blending both markets and identity and access control in a way that really solves a lot of like phishing and all of the like problems we had. It's like if you use your crypto day to day for mundane tasks and it's easy to use, you're not going to lose it. No one's going to steal it. And all of a sudden, you really could be your own bank or your own brokerage firm.
Love it. Brilliant. And as someone that is deeply connected to policy conversations and industry leaders like David Sachs, I've got to ask, what's your read on where the US digital asset regulation is heading right now, particularly in light of the election cycle? There were many different predictions. I'm not sure where people stand now or what to think anymore, but where do you see this heading? Are you largely positive?
Very positive. I would say that, first of all, on the executive side, I had maybe the most productive meeting with government ever when on our first crypto task force meetings. Without getting too into the detail, just because of the conversation, I was asked, if we had any roadblocks to the Permuto product. And I was like, well, there's this one issue maybe over at Treasury, and a very senior SEC person started like yelling, if they haven't fixed it already, we're going to yell. I'm like, whoa, we haven't asked yet. but that's the like lean in that we're seeing from the executive branch. I also think that it's important to note the politics of the fact that crypto took some scalps. There is one less anti-crypto senator out there. The message has been made very clear to Congress that, we need to be serious about this. There are real opportunities. One of the things we're proud about Permuto is it really starts to articulate, why do you need a blockchain? A different conversation with the government yesterday. They're like, why do you want this on a blockchain? I started walking through all of the reasons we just kind of talked about. And they're like, oh, crap. It really is going to be more investor friendly and cheaper and safer. Like up to and including the point where one of our senior securities lawyers on the call was like, my mom likes to put her stocks in her safe. She thinks it's safer. And frankly, I keep some of my stuff at DTC and not in brokerage firms because like 2008 happened. Right. Yeah. So, it's like, look, I'm sorry, but there are systemic risks. I'm not interested in them. But I think, we're going to see hopefully progress in stable coins. I think that's a little bit of political grandstanding in the 24-hour moment, if you will. But I think ultimately, there's very little downside to stable coins and especially dollar hegemony against them, because one of the hardest things for, I think, a lot of banks and regulators to get their head around is that money's now software. And software is adopted based on how easy it is to use. And so you can have all sorts of policy reasons why you don't want to make it easy to use. And that just means Tether will make it easy to use and get adoption, and you won't. And it's a new thing. I mean, I've actually had to say this to a couple of folks. It's like, look, last time Bram and I did this, Tower Records and Blockbuster did not do very well. And Disney really didn't want this to happen. And I'm sorry, but Disney's better at stopping stuff than most government entities are. And they didn't stop BitTorrent and the, coming, you may buy your stuff relatively easily and use it cheaply movement. Yeah, that. Yeah. So I'm more than cautiously optimistic. I was a little worried we might swing the pendulum too far the other way. And the good news is I think both centrist GOP and centrist Dems are wanting to make sure that we get what we need, but not throw the baby without the bathwater. We still need securities laws. Like, it turns out that like core securities laws are, for 400 years, people have been being horrible to each other around investments. Like, it turns out we need some regulations there. But using them as a cudgel and having no path, these were problems that need to be fixed. So I think the good news is we've got about the right balance, both politically and economically, if you will, that we're going to see the right kinds of things come through and a lot more clarity. And, it makes it just so like I mean, I'll give you a great example. The big boys here, so the big top 5 commercial banks, they're like, okay, look, we know right now we can do whatever we want over the next 3.5 years. But then what happens if year 4 things change? Are we going to be in trouble? And so I think stabilizing that a bit for them so that it's like, okay, this is actually a validly passed congressional act. We're going to be able to work under it and not worry about whether like a future regime tries to say our stable coin is illegal.
Well, thank you so much for coming on and joining me today and talking about this in a language that everyone can understand. I know many people find it a little bit daunting that are outside of this space, but I think you've done an amazing job here and so much food for thought on some of the topics that you talked about. And as you said, we're not talking about right here, right now. What happens 2, 3, 4 years down the line. And before I let you go, though, one of the things we always do on this podcast, I ask my guests to either leave a book that they'd recommend that we can add to our Amazon wish list or a song to our Spotify playlist. So before you go, what is that final gift you'd like to leave everyone listening and why?
Well, look, as Mr. eMusic, it's very hard for me to choose just one song. So I'll instead give you a book, and that is Knowledge and the Wealth of Nations. It is the story of Paul Romer's kind of original work. And what it is kind of taking the Adam Smith view of, okay, but how does knowledge create wealth? Like what really creates wealth? One of the things I always like to do is kind of reason from first principles. It's like, okay, how do we get here? Why do we get here? It really helps me when I'm thinking about, because the one thing you can't take out of technology advancement is the human. And so it's like, okay, the human makes a bunch of assumptions about what the human thinks it wants. And, this is that classic story of, Steve Jobs going, well, you would have gotten another BlackBerry. No thanks. Right. But when you're really thinking about, okay, so what generates that, that wealth effect? It really is, knowledge and how that works. And it's like, what's fascinating about that book is it really breaks down kind of the 2 types of knowledge, because there's both kind of, how do I put it, tactical knowledge. It's, how do you most efficiently operate a cotton gin, right? That's not necessarily an aha, but it does turn out that being able to articulate that and have different societies adopt that, really increases their GDP and all these things versus a Jobs looking at this entire space and going, y'all don't know you want an internet computing device. And in fact, on the announcement of the iPhone, he talked about it being a phone and a text messenger and then an internet device. And everybody was like, what the hell is this internet device thing? Of course, it turns out almost none of us use the phone anymore. Yeah. Right. So he was absolutely right about what the world needed. The world just didn't know it yet. And so that other version of true invention, and I think that's kind of what that looks like. Those are those step function leaps. And in fact, like Bram figuring out how to use space instead of work to, secure a blockchain is exactly that kind of thing. It's that, hey, I think people going down this other road are on the wrong road. If we went this road, we could get all of the security and use 3% of the total energy outlay, right? It's those big steps that really create wealth, because all of a sudden, I'm no big fan necessarily of Microsoft, but I always like to tease people that like, do you think Bill Gates captured all the value Excel created? And the answer is no, right? I mean, there's a whole bunch of people who have interesting jobs because they know how to run Excel, and, yes, they're getting a little of it, but no, Gates is not getting all of it in any way.
Oh man, brilliant. I'm going to get that added straight to our Amazon wish list. I'm going to be checking that out myself. And for anyone listening wanting to find out more about Chia's blockchain technology, Permuto's platform, etc., where would you like to point everyone to so they can find out more information or even join your community too?
Sure. So we're active on X. I'm Hoffmanji on X. There's also a Discord. You can go to chia.net. In the bottom, you find the Discord link. Available there more often than you might imagine. Both, Permuto and Chia, both on X, as I said, and there's actually a Permuto Capital channel in the Discord as well. Also, Bram Cohen on X, you'll see him here and there as well. So, we're both pretty available and love to chat about these sorts of things.
Awesome. Well, we covered so much there, and I would like to throw this out to everyone listening, what they think of this concept here of splitting listed stocks into separate dividend certificates and appreciation certificates, with indeed Microsoft stock set to be the first equity offered on your platform. Please, everyone listening, let me know your thoughts on that. But more than anything, just a big thank you to yourself, Gene, for coming on, shining a light on it and starting this conversation. Thanks for doing that.
Well, thank you, Neil, and thanks for the opportunity.
I think as we learned today from Gene Hoffman and the team at Chia, they're not just talking about the future of finance, they're actively playing a part in building it. Whether it's through that new platform and its tokenization of equities like Microsoft, or Chia's broader commitment to working with regulators and delivering secure, compliant blockchain infrastructure, there seems to be a clear vision here, making capital markets more flexible, more transparent, and more inclusive. And this idea of separating dividend and growth exposure could fundamentally change how portfolios are constructed and managed, especially for those who need more control over risk and income. And with regulatory scrutiny increasing around crypto, Chia's willingness to engage with the SEC and prepare for public listing shows a real maturity that many in this space are still lacking. But what do you think? Could this be the next step in the evolution of EFTs? Would you want the option to buy dividend income without riding the roller coaster of growth stocks? Join the conversation. Share your thoughts. Email me, techblogwriter@outlook.com, X, Instagram, LinkedIn, just @NeilC.Hughes. As always, let me know your thoughts. We'll keep this conversation going. And I also cordially invite you to keep an eye out for the next episode in your podcast feed, which will be there the next time you hit refresh, hopefully. So keep a listen out there. Check out the Tech Talks network, where you'll find 8 of my podcasts, all honing in on different areas of technology, business, and our life. Hopefully, I'll speak with you all again then. Bye for now.